Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the federal funds rate and what could be a terminal rate eventually. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Now, I know what a lot of you are thinking. You're probably wondering, when are we going to jump back into the cryptoverse? You probably subscribed to this channel because it was your understanding that you would be jumping into the cryptoverse every day. Unfortunately, over the last several days, we continue to go to a black hole and find ourselves in the macroverse. And of course, it is September of 2022, and as I've said before, at this point, we're all essentially armchair economists. I do want to spend just a few more minutes in the macroverse. I do promise you we will get back to the cryptoverse relatively soon, but let's talk about something in the macroverse. And ultimately, I do think this will help us have a better understanding of how the cryptoverse generally operates. So what we're going to talk about in this video is a theoretical terminal rate for the Fed funds rate. And if you followed my line of thinking this year, my general base case for the terminal rate on the Fed funds rate is approximately between 4 to 5%. Okay? Now, 4 to 5% is kind of where I've been the entire year. And for quite a long period of time, markets simply did not agree with this. They did not agree with this assessment. I think a lot of market participants were thinking that the Fed was bluffing. To be completely honest, and you could go to you could go to CME Group and go back to historical snapshots and whatnot and see that it really has taken a long time for investors to sort of to just sort of like finally accept that the Fed is not pivoting right now. It's been a long process, but acceptance is coming nevertheless. And if you look at the November meeting, markets are currently saying there's a 69% chance, almost a 70% chance here of another 75 basis point rate hike, which would mean four 75 basis point rate hikes in a row. Now, look, the Fed told us they were going to front load interest rates. So, I mean, let's try to not act that surprised. This is what they told us. And if you've just been going with what they've said for the entire year, you have not been surprised because they're just doing what they said they were going to do for the entire year. And I think you have to remember that inflation is high, so their motivation is different this time than perhaps it has been over the last 15 to 20 years, or even 30 to 40 years. Now, if you go further, if you go to December, you'll notice that the Fed funds rate, the most likely probability is going to be about 70% probability between 4.25 and 4.5%. Okay, so the market is already thinking there's a good chance interest rates could be 4.5% by the end of the year. 6 months ago, unheard of, right? Completely unheard of. Markets did not agree with this assessment. Now, the idea of getting to a 4 to 5% for the Fed funds rate, when I said this, and I've sort of been talking about this for a long time, I am kind of surprised that we're potentially getting to 4.5% this year. I thought we would get to 4% this year and then move higher next year. The idea here that we might get to 4.5% this year. I mean, I can't say I'm upset about it. I want I want inflation to come back down. I recognize that it takes a while for interest rates to have an effect, but I'm kind of in the camp of let's just rip the Band-Aid off and hopefully get things over with rather than have it sit around for a long time. But if you go further out, if you go to March, you can see that people are thinking it'll be somewhere between 4.5 to 4.75%. 37% chance it goes up to 5% by March. 37%, 37.5%. By May, you can kind of see that people are not really thinking it heads much higher. And then as you get further out, let's go to say July, and then if we go to say September, it looks like it hasn't really changed a whole lot, and it'll likely still be somewhere in the 4.25 to 5% range. If you go to December, not much change, right? Not much change. Now, one of the things, though, that we could actually look to get a better understanding of a potential terminal rate is to look at interest rates with the 2-year yield in mind. And I'll show you what I mean. If you go to the chart of U.S. interest rates, this is what you get, all right? We're going to zoom into going all the way back to 1988. Then we're going to look at the 2-year yield. Let's go back to 1988. Okay. Now look at this, and then look at interest rates. And then look at the 2-year yield. And then look at interest rates. And the 2-year yield and interest rates and the 2-year yield and interest rates. If you look closely, they look really similar. Really similar, okay? Let's overlay them. This is what they look like. Huh. Now, my thinking, again, is that the terminal rate, as I've said, is probably going to be between 4 to 5%. This is my base case. This is my base case. I was always very skeptical that we would, the terminal rate would be anywhere less than 4%. I think 4 to 5% is kind of the sweet spot. With that said, we have to remain objective. It's easy to run with a narrative and pretend like something's going to happen because that's what you said or that's what your base case is. And my base case is that the terminal rate will probably peak somewhere between 4 to 5%, or hit. That's where the terminal rate will be. But we have the luxury to change our view based on incoming data. What I mean by that is that as long as inflation stays high and unemployment stays low, the general assumption should be that the Fed funds rate is going to keep climbing. Okay, that should be the general assumption, as long as unemployment's low and inflation is high. What do you notice about this chart? There's a few different takeaways. So the white line is interest rates, and the blue line is the Fed funds rate. What do you notice? Go back to 1989. The Fed funds did not hit its terminal rate until after it went above the 2-year yield. Okay? It's not my opinion. This is what happened. It did not hit its terminal rate until it went above the 2-year yield. You can see it clear as day right here. In 2006 and 2007, interest rates did not hit their terminal rate until it went above the 2-year yield. What's interesting right now is that the 2-year yield is at 4.118%, but interest rates right now are only at 3.25%. Even if we raise by another 75 basis points in November, we're still below the 2-year yield, and the 2-year yield is still climbing relatively quickly. So who knows where it's going to be in another month or two. But that's where it currently is right now. So one of the things that I think is worthwhile to consider is that history shows that there is some compelling evidence to suggest that we might not hit the terminal rate on the Fed funds rate until it's above the 2-year yield. Now, that will be highly dependent on unemployment and inflation. Okay? So again, if unemployment starts shooting up quicker than the Fed anticipates, then we should be quick to sort of soften up our stance. If inflation stays high and unemployment stays low, then what do you think the Fed's going to do, right? They're just going to keep raising interest rates. And maybe they're chasing essentially this 2-year yield. I mean, they're probably not, but right, the markets kind of suggest there's a chance that they're just chasing the 2-year yield. Now, there are a couple times where you can see that's not the case, right? I mean, over here in 95, we didn't even get close. And then also over here, we got relatively close back in the dot-com bubble. We got relatively close. But this is an interesting chart. Now, what I want to do is I want to look at this in a different way. So we're going to take one and why don't we subtract out the other? Okay, so we'll do that over here. So we'll take the 2-year yield and we're going to subtract out interest rates. All right, simple enough, right? Simple enough. We don't need a log scale for this. And then we'll look over here, what's going on with it. And this is what it looks like. We will draw a line at 0, so we know when they flip over. If I can get it here, let me try to get it right at 0. There it is. Okay. So, and then I suppose we should overlay. Should we overlay let's overlay interest rates on a new price scale. So what you notice, and the way this, this should work out here, is that we hit the terminal rate right here. So on that line right there, where did we hit the terminal rate? Oh, color on changes too. We hit the terminal rate right there in 06, right when it went below zero. So right when interest rates went above the 2-year yield. And then you can also see over here, right here, we hit the terminal rate right when interest rates went above the 2-year yield. Those are the two most compelling pieces of evidence that we could see something like that play out again. Of course, it doesn't always happen, but that is something that I think is worthwhile to look at, right? I mean, it's not, I wouldn't say take it to the bank, right? They're not going to cash it in for you. That you could go to the bank and get a CD if you want to, to earn 4% or something. But this is something to, to keep in mind. And the other thing to keep in mind is this: the Fed has never been this far behind the curve as much as they were back in April. Well, maybe that's not true. They haven't been that far behind the curve since what? Since 94. Okay. So you're talking almost 30 years ago. Has the spread been that different? Right? You can see the spread right here. It's been quite a long period of time since it was quite that bad. Now, there's something I want to touch on, and this is going back to my most recent video, and I'm trying to remember what it was. There's a question I saw, and I'm gonna go back and try to look at this really quick if I can remember. I think it was so I was looking at interest rates and the S&P 500. So let me do this. Okay, so we want the S&P, and we want to pin this to a new scale, and we want to make it a logarithmic scale. No, wrong one. So we want to make this one a regular scale, and we want to make this one a logarithmic scale. So one of the things I think that was pointed out is that I believe it was, someone basically said that, there have been times when the bottom occurred at the beginning of rates being cut, right? So someone did say that, but I think what people were wondering about, and this is a valid point that we should note, is that in the past, when interest rates were going up, so too was the stock market. Okay? Interest rates going up, so too was the stock market. That's something we've generally seen. And this time, and one of the things I said before in the last video is that if history is any indication, then the bottom for the stock market might not be when the Fed pivots. Okay, it might not be. It could be at the end of their last rate cut. And then a lot of people point out, well, what about the fact that we're going down while they're hiking interest rates, which is kind of different than what we've seen before. Like if you look at what we've seen before, the Fed was raising interest rates right here, but I mean the market was going up. My interpretation of what's going on, my potentially naive and ignorant and whatever interpretation, is the Fed should have been raising interest rates long ago, okay, in 2021. They should have been raising interest rates back then. And who knows why they waited until 2022? Doesn't really make a whole lot of sense. I mean, I think they are just so far behind the curve. Like, again, if you go back to that other chart that I just showed you, the difference between the 2-year and the 2-year yield and interest rates, right? The spread was so high back in April of 2022, showing that the Fed is so far behind the curve. They're so far, they have so much ground to make up. That's why they're front loading interest rates, because they realize they should have started this process probably a year before they did. If they had started it sooner, they could have been raising interest rates not into a slowing economy, but into a booming economy. And therefore, the market probably could have absorbed it a bit better. And then by the time we had the downturn, they could have started to cut rates to try to help with that. But instead, this time they waited too long. Now the market's going down, but they can't cut rates because inflation is high. So I don't really think the Fed is making a policy mistake right now. The policy mistake was made last year. Um, I think we're living in the world of dealing with the repercussions of the policy mistake they made last year, not necessarily dealing with a potential new policy mistake. I mean, they could make a new policy mistake, but I don't think a policy mistake is happening this year. Maybe it happens next year if they go up to say like a 6% for the Fed funds rate and they don't give it long enough to for the funds to or for the interest rates to really take hold in the economy. I think it could take 12 months for the economy to actually feel it. But this is just something to consider. I mean, about how I think this will go down for the Federal Reserve as a policy mistake, the fact that they waited too long to raise interest rates. And furthermore, Bitcoin, went up to 64K in early 2021. All of my models told me that that was the top, right? If I'm being honest, I mean, that was where the models told me that was the top. And that's where I took most of my profits in crypto for this last cycle, was back at the first peak in 2021. The second peak in 2021 seems like we got there from over-levered people, from over-levered positions and almost sort of willing us there. But perhaps if the Fed had raised interest rates when they should have in earlier 2021, then maybe Bitcoin wouldn't have even seen a new all-time high. Maybe that wouldn't have happened. I mean, we can talk about maybes all day, but I mean, it's just something to consider. So I think it's probably worthwhile to keep an eye on the Fed funds rate with respect to the 2-year yield, and to think about the idea that it might take the Fed funds rate getting above the 2-year yield, which is a moving target in and of itself, before the terminal rate is in. Okay, so if you zoom in here, you can see the 2-year yield's moving higher. The Fed funds rate is trying to play catch up here. If you can imagine in November, if we get another 75 basis point rate hike, it's going to take us up to about 4%. I don't know exactly where the 2-year yield's going to be if it stays constant, which it probably won't, but if it did, we would at least be getting close to it. So imagine sometime over the next 3 to 6 months, if the Fed funds rate, let's say, gets up to close to 5% and the 2-year yield is slowing down a little bit, then perhaps that'll be the terminal rate. But if the 2-year yield continues to go up quicker than the Fed can keep up with it, then maybe the Fed has to raise higher than a lot of people think they're going to. These are all important things to keep in mind. As I said, we will be jumping back into the cryptoverse relatively soon, but I just want to make sure people have a good handle on what's going on in the macroverse so we can better navigate the cryptoverse, especially as we try to figure out, when will the next sustained bull market be for Bitcoin. Look, guys, in the short term, anything can happen for Bitcoin. I mean, it could be at 16K next week. It could be back to 24K next week. I don't really know what's going to happen in the short term. I just don't have any high expectations for cryptocurrency in general while the Fed's draining liquidity from the system. Okay, that's my main argument. And furthermore, I would argue that out of everything, Bitcoin still remains the safest play within crypto until there's more clarity on regulations with the altcoin market, and who knows what's coming our way over the next several months. So anyways, hopefully this was useful. If you guys like the content, you can always follow me on Twitter as well. I'm a little bit more active there. And you can also, we have a free newsletter. Sign up to that if you like. You can find a link to that in the description below or in the pinned comment. We'll wrap it up there. Thank you guys for tuning in. Subscribe. See you next time. Bye.